Right now, as you're watching this, gold is trading above $4,100 an ounce. A year ago, it was around $3,200. That's an $850 move in 12 months on an asset that most people were taught pays no dividend, produces no cash flow, and does nothing. Meanwhile, silver just crossed $60 an ounce for the first time most people alive have ever seen. And the 10-year treasury, the thing that's supposed to be the safest, most boring investment on the planet, is yielding somewhere around 4.5 to 4.6%, even though the Federal Reserve has held its benchmark rate steady for months and is now talking about maybe hiking again instead of cutting. None of that should be happening at the same time, not according to the textbook anyway. So here's what's actually going on, why it's happening right now in the middle of 2026, and what it quietly means for the money sitting in your bank account and your retirement account, whether you've noticed any of this or not. Because the system isn't crashing. Nobody's ringing a bell, there's no siren. It's doing something a lot sneakier than crashing. It's repricing itself, quietly, in the background, while everybody's attention is somewhere else. Let's start with the basics, because I don't want to lose anyone here. A bond is basically an IOU. You lend the government money, they promise to pay you back later with a little interest on top. The yield is just the interest rate you're getting paid for the risk of lending it. Inflation is the rate at which your money loses buying power over time. A dollar today buys less bread, less gas, less anything than it did last year. And the Federal Reserve, the Fed, is the institution that sets short-term interest rates in an attempt to control how fast prices rise or fall. That's it. That's the whole toolkit at the basic level. Everything else is just those three ideas colliding with each other in different combinations. Okay, reason one. The bond market and the Fed are no longer telling the same story. And that's new. For most of the last 40 years, when the Fed held rates steady or cut them, long-term bond yields tended to follow along, more or less. That's the textbook relationship. But right now, the Fed held its policy rate at 3.5 to 3.75% back in June under its new chair. And instead of signaling future cuts the way markets expected, the committee actually raised its inflation forecasts and left the door open to hiking further, with some projections putting the rate near 3.8% by year end. That's hawkish. That's we're worried about inflation, not growth. And yet, and this is the part that should catch your attention, the 10-year yield has kept climbing anyway, up into the mid 4% range. Normally, a hawkish Fed holding rates high is supposed to keep long yields anchored or even pull them down as investors price in slower growth. Instead, long-term yields are rising right alongside short-term ones. When that happens, it usually means one thing. The market doesn't fully trust that inflation is under control, no matter what the official target says. Bond buyers are demanding more compensation to hold government debt for 10 years because they're pricing in a world where the dollar they get back is worth less than the one they lent. That's reason one. The bond market is quietly voting no confidence. Reason two. Look at what's happening in commodities priced in dollars versus commodities priced in almost anything else. Gold at 4,000 plus, silver near 60. Even industrial metals have been grinding higher. Now, the easy explanation people reach for is everything's just getting more expensive, inflation, blah, blah. But that's actually a little bit backwards, and here's the more interesting way to look at it. It's not that gold is getting more valuable in some abstract sense. Gold is still just gold, same shiny rock it's always been. It's that the ruler we use to measure its price, the dollar, is getting shorter. Inflation isn't really about things costing more. It's about the thing we use to measure cost getting smaller. And when you chart commodity prices in gold instead of dollars, going back over 100 years, the line is a lot flatter than the doom and gloom charts you see online. That tells you something important. The volatility is coming from the measuring stick, not from the stuff being measured. Reason three, and this one's bigger than most people realize. Central banks are buying gold at a pace we have not seen in modern history, and they are not doing it quietly by accident. They're doing it on purpose, and they're telling us so. In the first quarter of this year alone, central banks added 244 tons of gold to their reserves, up 17% from the quarter before. In May, they added another 41 tons net. Poland has been buying for 4 straight months in double digits and now holds over 600 tons, working toward a self-stated target of 700. China has now bought gold for 20 consecutive months in a row, 20 months without pause, and its official reserves are pushing past 2,300 tons. Uzbekistan, Kazakhstan, even Singapore, which hadn't been a net buyer since last September, jumped back in. And when the World Gold Council surveyed the actual people who run these reserve portfolios for a living, 89% of them said they expect global central bank gold reserves to rise over the next year. A record 45% said their own institution specifically plans to add more. This is not a rounding error. Central banks have been accumulating gold at roughly 1,000 tons a year on average over the past 4 years, double the 500-ton average pace of the decade before that. Something changed, and the people whose entire job is managing sovereign wealth for a living are telling you, out loud, in surveys, what they think is coming. Reason 4. The dollar's role as the world's default reserve currency has been quietly eroding at the edges for years, and this year's geopolitical backdrop, ongoing tension in the Middle East, energy price shocks feeding directly into inflation numbers, has only sped that up. Over the last decade, a block of major economies has been building alternative payment systems, specifically so they're less dependent on the dollar for settling trade. At the same time, those same countries have been shifting their reserves out of dollar-denominated paper and into physical gold at a pace we've genuinely never measured before. Both of those movements, building around the dollar and stacking hard assets instead of paper claims, are happening simultaneously, right now, while most people are watching literally anything else. So that's 4 separate, independently verifiable threads. The bond market pricing in distrust, gold and silver repricing against a shrinking dollar, central banks buying physical gold at a historic pace while telling surveyors they'll keep doing it, and a slow structural pivot away from dollar dependence on the world stage. 4 threads, same rope. Okay, quick pause, because I promised you something at the top of this video and I want to deliver on it before we go further. If any part of what I just said made you a little uneasy about how your own retirement savings are positioned, whether that's a 401k, an IRA, whatever you've built up, there's a free guide I put together that walks through how people are protecting retirement accounts from exactly this kind of currency and bond market pressure. It's linked right below this video, or you can just scan the QR code on the screen right now if you're watching on your phone. Doesn't cost anything, takes a few minutes to read. Okay, anyway, back to it. Let's go deeper, because the why now question deserves a real answer, and the best way to get one is to look at what's happened the last 2 times the world went through something similar. Go back to August of 1971. Richard Nixon goes on television on a Sunday night, Sunday, so markets wouldn't panic before he could explain himself, and announces that the United States is suspending the convertibility of the dollar into gold. Up until that moment, foreign governments could technically show up with dollars and demand gold in exchange at a fixed rate of $35 an ounce under the Bretton Woods system set up after World War II. But by 1971, the US had spent so much on the Vietnam War and domestic programs and printed so many more dollars than it had gold to back them that other countries, France in particular, started actually doing it, showing up, demanding the gold. And the US realized it physically did not have enough gold in Fort Knox to honor all the dollars floating around the world if everyone asked at once. So Nixon just stopped, closed the gold window. Overnight, the dollar became what's called a fiat currency, valuable because the government says it's valuable, and because people agree to use it, not because it's redeemable for a fixed amount of anything physical. Within 2 years, gold went from $35 an ounce to over $100. Within a decade, it hit $800. That wasn't gold becoming more magical. That was the world repricing the dollar's credibility after the backing was removed, in real time, and it took years to fully play out. Now go forward to 2008. Different mechanism, same underlying story. The global financial system nearly seizes up because banks had quietly built enormous piles of risk on top of mortgage debt that turned out to be worth far less than everyone assumed. Lehman Brothers collapses in September. The Fed and Treasury respond by doing something that, at the time, felt almost unthinkable. They start creating money at scale, buying up trillions in assets to keep the financial system from freezing solid, a policy that later gets the label quantitative easing. It worked in the sense that it prevented a total collapse, but it also meant the world's reserve currency was being expanded faster than at almost any point in peacetime history. Gold, which had been sitting around $800 an ounce before the crisis, climbed to over $1,900 by 2011, more than double, as investors, and yes, central banks, quietly recognized that the dollar's supply had just been permanently altered and priced that in. Here's the pattern in both stories. The actual event, Nixon's announcement, Lehman's collapse, is not the moment the repricing happens. The repricing happens gradually over the following years as the world slowly adjusts its trust in the currency to match the new reality. What we're watching right now doesn't have a single dramatic headline moment, like a Sunday night presidential address or a bank collapsing on live television. It's quieter than that. It's happening through central bank purchase reports released monthly on a government website that almost nobody reads. It's happening through bond auctions where yields creep up a little more than expected. It's happening through a Fed chair adjusting an inflation forecast half a percentage point in a press release. No bell, no siren. Just numbers, quietly moving, that add up to the same kind of repricing 1971 and 2008 eventually produced. Except this time we can actually watch it happen in the data as it unfolds, if we're paying attention. Now, hold on. I know what some of you are thinking, because I'd be thinking it too. You might be saying, wait a second, if the Fed is holding rates high, or even threatening to hike again, isn't that supposed to be good for the dollar? Higher rates usually attract capital, strengthen the currency, cool inflation. So why would gold and silver be ripping higher and bond yields be climbing at the same time as a hawkish Fed? Shouldn't those two things be pulling against each other? That's a genuinely good question, and the honest answer is, normally yes, they would pull against each other. But there's a difference between a currency being strong because the underlying economy and finances are healthy, and a currency being propped up by a high interest rate while the debt behind it keeps growing regardless. Higher rates make the dollar attractive to hold in the short term because you earn more interest on it. But higher rates for longer also make it dramatically more expensive for the US government to service its own debt. Every dollar of that debt that rolls over now gets refinanced at a higher rate than it was issued at. That's a slow motion squeeze. It doesn't show up as a single crisis. It shows up as a growing share of the federal budget going to interest payments instead of anything else, year after year, quietly. Central banks managing reserves for the next decade aren't just looking at this month's interest rate. They're looking at that long-term math and concluding that a hawkish Fed today doesn't erase a structural debt trajectory that's been building for 20 years. So they hedge. Not by abandoning the dollar outright. The US financial system is still the deepest, most liquid in the world, and nobody's walking away from that tomorrow. But by quietly adding a percentage point or two of gold to their reserves every quarter, as insurance, just in case the confidence in that long-term math cracks, the way it did in 71 and 2008. High rates and rising gold aren't actually contradictory once you separate attractive to hold this month from structurally sound for the next 20 years. That's the nuance the simple headline misses. Let me give you a way to actually feel this in your gut, instead of just as numbers on a screen, because I think it makes the whole thing click. Think about a casino chip. When you walk into a casino and trade a $100 bill for chips, that chip isn't money. It's a claim on money, backed by the house's promise that they'll redeem it later. As long as everyone trusts the house, chips move around the table just like cash. People bet with them, trade them, stack them up, feel richer or poorer based on the pile in front of them. The chip works perfectly, right up until something makes people wonder whether the house can actually make good on every single chip in circulation if everybody cashed out at once. Now imagine the house, without telling anyone outright, quietly starts printing more chips than it has cash in the vault to back. For a while, nothing changes. The game keeps going, people keep betting. The chips still get accepted at the tables because habit and trust are powerful things, and nobody's actually testing the vault. But some of the sharper players at the table start noticing the ratios off. They don't panic and run for the cashier window. That would tip everyone off and look foolish if they're wrong. Instead, they quietly start converting some of their chip winnings into something the house can't just print more of. Maybe they start asking for a cut of the actual physical cash drawer instead of more chips, or they trade chips for a physical asset sitting on the table that has value independent of the house's promises. That's what central banks buying gold actually looks like, in slow motion at the scale of entire nations. They're not cashing out of the dollar system. That would be disruptive, and honestly, there's nowhere else big enough and liquid enough to park trillions of dollars anyway. They're doing the quieter, smarter version, converting a slice of their winnings every single month into the one asset at the table that isn't anybody else's IOU. 20 consecutive months for China, 4 straight months of double-digit buying for Poland. That's not panic. That's a room full of sophisticated players, one chip at a time, quietly hedging against a vault they can no longer independently verify. So who exactly is doing this? specifically, with names and numbers. The People's Bank of China has bought gold for 20 straight months and now holds over 2,300 tons, about 9% of its total reserves, still low by historical standards for a country its size, which tells you they likely have room to keep going. The National Bank of Poland has been the most aggressive single buyer this year, adding 64 tons year to date, and explicitly stating a target of 700 tons total, treating gold as a deliberate strategic reserve allocation, not an afterthought. The Central Bank of Uzbekistan and the National Bank of Kazakhstan have both been steady, consistent monthly buyers, together adding over 50 tons this year. The Monetary Authority of Singapore just rejoined the buyers after nearly a year on the sidelines and is separately building out gold vaulting infrastructure to position itself as a regional gold trading hub. That's not a short-term trade. That's an institution building physical infrastructure for a multi-decade role. Meanwhile, Turkey and Russia have actually been net sellers this year, which sounds like it contradicts the story until you realize those sales are largely driven by those countries' own domestic financial pressures and sanctions exposure. Special situations, not a vote of confidence in paper currency. The broader signal from the World Gold Council's own survey of the reserve managers who make these decisions for a living is almost unanimous. 89% expect global reserves to keep growing. So let's pull this together and ask the question everyone actually wants answered. What does this mean for the three things most people's financial lives are actually exposed to? Stocks, gold, and the dollar itself. Stocks, for now, are mostly riding on corporate earnings, and especially this cycle, a massive wave of investment tied to artificial intelligence infrastructure. Data centers, chips, power generation to run all of it. That's real economic activity, and it can coexist with everything we've talked about for a while, sometimes even for years. But stocks are priced in dollars, and if the dollar's purchasing power keeps eroding in the background, the way the bond market and the gold market are both quietly signaling, then a rising stock number on your brokerage app doesn't automatically mean you're getting richer. It might just mean the ruler measuring your gains is shrinking underneath you, the same way commodity prices look explosive in dollars, but flat in gold. Nominal gains and real gains are not the same thing, and that gap is exactly where people get caught off guard. Gold and silver, in this environment, are functioning the way they functioned in every version of this story going back to 1971 and 2008, as the pressure valve. When trust in the paper promise wobbles, even a little, price discovery happens in the one asset that isn't anyone's liability. That's not a prediction that gold goes up forever in a straight line. It never has. Historically, it moves in waves. But the structural buyer underneath it, central banks adding roughly 1,000 tons a year, with 89% of them planning to keep going, is a demand floor that simply didn't exist at this scale a decade ago. And the dollar itself sits in the middle, doing the thing currencies do when trust erodes slowly instead of collapsing suddenly. It keeps functioning perfectly fine for every single transaction you make this week, while very slowly buying less and less of the real world underneath the surface, exactly the way it has, quietly, for every year of your entire life. The chips still work at the table. They're just worth a little less every time you cash them in. So let me tie this all together. 4 separate threads. A bond market pricing in distrust rather than following the Fed's lead. Gold and silver repricing against a shrinking dollar rather than becoming magically more valuable. Central banks buying physical gold at the fastest sustained pace in modern history while telling surveyors flat out they'll keep doing it, and a slow structural pivot away from total dollar dependence happening in parallel, all point in the same direction. Not toward a crash, not toward some specific date you should circle on a calendar, toward a quiet, gradual repricing of trust, the same shape we saw play out over years after 1971 and after 2008, except this time the data is public, monthly, and sitting right there on a website almost nobody checks. The people who run the actual reserves of entire nations are not guessing about this. They're positioning for it, 1 ton at a time, every single month, and they're telling us so in their own surveys. The question isn't whether something dramatic is about to happen tomorrow. The question is simply whether you're paying the same kind of attention to your own money that they're paying to theirs. If this resonated with you at all, and you've got a retirement account north of $100,000 that you'd like a second set of eyes on, I also want to mention there's a free one-on-one educational web conference available for people in exactly that position. No cost, no obligation, just a real conversation about how these bond, gold, and dollar dynamics might apply to your specific situation. You can find the details the same place as the guide, link below or the QR code on screen. Then it's back to you and whatever you decide to do with it. Before you go, just remember the guide and the QR code are right there whenever you're ready. No rush. I hope you have a wonderful rest of your day, and I'll see you in the next one.